So we're still looking at MayJune 2017. This is question 4. It's 5 marks at 6 minutes. It's very short. It's all theory, no calculations. The first question says, match the accrued income general ledger account to one of the listed categories. Right, so what is accrued income? Do you remember the definition?
Yes, it's income that's basically built up over a period of time that's not being paid.
Yes, similar to debtors.
Yes.
Good, so that's a current asset. Okay, so the answer to number 1, current asset.
Yes.
Let's record that in our workings. Okay, so question 4. Question 4. Number 1, option 1A.
4.2, I don't know.
Okay, the next one says, which of the following options constitutes the underlying assumption that is relevant to all financial statements? Okay, this is very specific theory that comes from the textbook. Underlying assumption, all financial statements are prepared on a going concern basis, meaning we would expect the business to continue operating in the future. Right, so that's option number D. Okay, going concern means the business will continue to operate in the future. Okay, number 3. A loan repayable within what will be classified as a current liability? Obviously, we're looking at time. So short-term liabilities must be paid within
12 months.
the current financial year.
Yes, the current.
Okay, so a loan repayable within the current financial year will be classified as a current liability. The current financial year, 6 months after the current financial year, 13 months after, no. 18, 24, no. Definitely not C, D, and E. 6 you could actually look at as being a current liability, because if I'm repaying off a loan and it's paid within the next 12 months, it would still be considered a short-term liability. So you could go with option 1, the current financial year. If you're paying off a liability in the current financial year, it would be considered, well, it would be paid off actually. So it probably is 6 actually, because it's within 12 months. So maybe just to revise the theory, if we pay a liability within the next 12 months, that will be considered a current liability. Okay, remember, less than 12 months, current liability. Okay, current asset, current liability, doesn't matter what it is. If it's less than 12 months, it's current. So looking at this, 6 months after the current financial year end, well, if it's within 12 months after the financial year end, it's still within 12 months.
Yes.
Yeah, so it would actually be acceptable to go with B or A, because A is in the current financial year. Obviously, if it's in the current financial year, it's short term. Right, so A and B would actually be correct answers here, because it's both of it is looking at the time associated with current and non-current. Okay, maybe just to double check if the textbook gives anything specific. They're current liabilities, disclosure, recognition, page 289. 289. There's it. Okay, so here in the textbook they say recognition of current liabilities, measurement. Do they give anything about time here? No, nothing about 12 months here. Disclosure, okay, their disclosure. They talk about previous chapters, purchases, creditors, purchases, returns. Okay, that's it in that chapter. Let's see in the beginning if they give anything here. In chapter 1, they talk about liabilities. There's non-current to current. Okay, so here they define a current asset as an asset shall be classified as current when it satisfies any of the following criteria. Expected to be realized in or is intended for sale or consumption in the entity's normal operating cycle, held primarily for the purpose. See, this is for a current asset. Expected to be realized within 12 months after the reporting period. See, so it's during the year or 12 months after. The same thing applies to a current liability. Let's see if they've given a specific definition here. Yeah, they have. Okay, so on page 26 of the textbook, current liabilities are debts that have to be settled in the short term, usually within a year, see, of the date of financial position. Liability shall be classified as current when it satisfies the following: expected to be settled in the operating cycle, held primarily for the purpose of a trade, due to be settled within 12 months after the year end. Okay, so both are acceptable. Okay, so A and B are actually right. A/B would be correct, and you can see page 26 textbook confirms that. Okay, the textbook gives more detailed information relating to the theory. Okay, which of the following combinations of stated concepts constitute the elements of financial statements? Okay, if we're looking at elements of financial statements need to be prepared on a going concern basis. And if we look at the elements specifically, okay, these are elements of the financial statements. It needs to be prepared in line with the rules, okay, assets, liabilities, income, expenses, capital, and drawings. And we need to have the different qualitative characteristics, which are given here on this page. No, before this, there's it, domains of, okay, there's the underlying objective, there's the users, financial performance, changes in equity. They want to know what the disclosure is, so that would be here. There, qualitative characteristics. Here they wanted combinations of concepts. Okay, so it's concepts or characteristics. Okay, I would go with characteristics here. On page 14 of the textbook, they give you all of them: relevance, faithful representation, comparability, verifiability, timeliness, understanding, and then they've given you some constraints there. Okay, so comparability, yes. Verifiability, yes. Timeliness, yes. Understandability, yes. Okay, so A is looking good. Going concern, no. Assightability, no, 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 no. Okay, so that's the one. A. A is correct. Page, qualitative characteristics, page 14 to 16. 14 to 16 textbook. And then the final question, which is theory. Which one of the following is not a common user of financial information? Okay, obviously, investors would use it to invest. Employees would use it to establish how good or bad the company is. Lenders would use it to give out loans. Suppliers would use it to consider whether the business can afford the credit or not. The cashier at the bank wouldn't use it. Okay, I mean, what is the cashier going to do with the financial statements? If the cashier was giving out a loan, then yes, but they wouldn't typically need it. So they said not a common user. So the cashier at the bank wouldn't be a common user of the financial statements. Everyone else would.
I said employees.
Employees would use it. Don't you use your financial statements?
Yeah, but not all employees.
Oh, well, okay, so how detailed are they going to go here? That's the big thing. Are they going to go deeper into, obviously, yes, you get different levels of employees, correct. You get employees that are more senior, employees that are more junior, and then obviously different users will be using the statements for different reasons. Okay, maybe just to check it here. Okay, so on page 8, users of financial information. Investors is there, employees is there, lenders is there, suppliers is there, customers is there, government, the agencies, public is there. Notice, cashier at the bank, not a typical user. Alright, so yeah, cashiers at the bank wouldn't be looking at your financials, right? Because that's just the cashier.
Yeah.
They're just counting money and putting it in your bank account. They're not doing anything other than, if they were giving loans, if they said financial advisor, if they said financial planner, if they said loan originator, someone giving out loans, then they would be looking at that. But common user, not the cashier at the bank. They're not going to want to look at that.
Because I also thought the cashier at the bank, but then I thought, okay, maybe if she...
Don't hesitate.
Maybe if she's doing a loan for us.
Yeah, but cashiers at the bank don't normally do loans. Financial consultants do.